Ladies and gentlemen, good day and welcome to the IndiGrid Trust Q4 FY24 conference call hosted by Nuvama Wealth Management. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Subhadeep Mitra from Nuvama Wealth Management. Thank you and over to you.
Thanks, Mike. Good evening, friends. On behalf of Nuvama Institutional Equities, welcome you all to the fourth quarter FY24 earnings call for IndiGrid Trust. We have with us today the top management of the company, represented by Mr. Harsh Shah, CEO and whole-time director, Mr. Naveen Sharma, Chief Financial Officer, Ms. Meghna Pandit, Chief Investment Officer, and Mr. Satish Talmale, Chief Operating Officer. I would now like to hand over the call to Mr. Harsh Shah for his opening comments. Over to you, sir.
Thank you, Subhadeep, and thank you everyone for joining the call today. I would like to schedule the call in a way that we will start with results, and I'll take you through the summary of the results in the quarter of this year, indicating to our presentation, and subsequently my colleague Meghna Naveen would take you through the rest of the presentation, and we will address the question and answer after that. Considering this is a last quarter results for the last quarter of the year, some of the comments we can also take about the full financial year and how it has gone by. I'll start with slide number 3 of our presentation, where we are describing the vision. Our vision remains to become the most admired yield vehicle in Asia, based on focused business model, value accretive growth, predictable distribution, and optimal capital structure. And I think, as evident in slide 4 in our portfolio, we have been able to deliver that over the last several years, and our portfolio has grown across different dimensions. Number of substation, number of transmission lines has grown substantially. Our solar generation last year has grown massively and it turned out to be a 1.1 gigawatt peak, which is almost like an 80% growth on the capacity. And we also obtained several best projects as well as transmission projects for the year. In general, if I start with slide number 6, which is our quarterly update for our business this quarter, we have won another greenfield ISTS project in Maharashtra. Besides that, we have won GVNL battery energy storage projects for 180 megawatt by 360 megawatt hour configuration. With this, in FY24, we have won 5 greenfield projects, largely in transmission space, with about 2,000 crores of outlay. This is a significant step towards our strategy, where we are pursuing towards growth via our bidding and adding, I would say, organic growth by focusing on projects that are closer to our assets as well as are closer to our skill sets in creating organic pipeline for IndiGrid. In this quarter, we also commissioned our first greenfield projects, which we had embarked on about 2.5 years ago, and Kalam Transmission Limited. And a new project that we have also won this quarter is also co-located at the same Kalam Transmission Limited, showcasing that having a synergetic presence in different regions allows us to be competitive and add more expansion in projects in the same region. Besides transmission and organic growth, we also acquired 300 megawatt of solar project from Renew. The asset is in Jaisalmer, and this asset was acquired at approximately value of about 1,550 crores. In the first best project, which was for customer BRPL, which is BSES Rajdhani in Delhi, we have received the approval from DERC. And this was a significant step because this allows us to start the project. And many a times after the bid, especially battery and solar projects get stuck on the final regulatory approvals. but we are pretty happy with the speed with which VRC and the customers have moved to get the approval so that we can start and break ground. On the financial performance, our quarter four revenue and EBITDA both witnessed 31% and 24% year-on-year growth respectively. Quarter four financials now include full quarter impact for the Virit assets and also revenue from Renew asset on a portion of the quarter. For the full year, revenue and EBITDA stood at approximately 2864 crores and 2460 crores respectively, which is a growth of 23% and 17%. Quarter four collections have been phenomenal in the transmission side with 119% and around 89% for the solar assets. For the full year collection, we received 103% and 101% respectively for transmission and solar, which is also the reason why we are adding substantial amount of NDCF for the financial year. With the phenomenal year, both on financial and growth side, the board has decided to meet its increased guidance at 3.55 rupees a unit, which we had raised after acquiring unit. And further guidance have been increased further by 6.4% to 15 rupees a unit annually for FY24-25. I would remind that we had raised the guidance mid-year last year. If one was to compare our original guidance for FY24, this 6.4% will almost look like a 9% increase from 12 months ago guidance that we had guided towards. Our net debt to AUM still remains at approximately 62.4%, owing to the capital that we raised over the last couple of quarters via both preference issue and institutional placement. And we continue to work to ensure that our net debt to AUM remains at a level which allows us to grow. Operating performance, our average quarterly availability was 99.52 and the annual availability has been 99.74, which is ensuring the maximum incentives for this financial year. Our solar CUF, including RSOPL, was around 23.9%. We also implemented something called asset health indexing for our entire substation portfolio to enable both predictive and proactive maintenance. You may recollect we had implemented IndiGrid about a year ago, and this is a further step in the same direction. On slide 7, while there are a lot of factual updates about the industry as it's growing, I would just describe our emotions. We are extremely positive on the way the power sector is growing, and we do feel that industry is getting a lot of tailwinds from the demand side, from regulatory circles, as well as the supply chain side, which is resulting into the government as well as the need of the customer becoming more and more apparent. And therefore, we are seeing that in transmission lines and substation itself, there is a sizable amount of pipeline are available for bidding over the next couple of years. And we do see that a sizable amount of this would be able to addressable target for IndiGrid, which will result into a sizable growth pipeline. This also is driven by a large amount of demand on the renewable side. And while we do not bid for renewable projects directly, such amount of capital requirement does require many of the developers to flip assets, and that becomes pipeline for us. And besides that, for this kind of renewable expansion, we are seeing a lot of planning already being undertaken for further expansion into transmission and battery storage, which remains our core areas where we look to bid. On the quarter four of operating performance, I would like to invite Satish Talmale to take you through the performance. Satish.
Thank you, Harsh, and hi everyone. On quarter four operation performance, so we achieved quarter with zero harm on HSE aspect. That means no major incident reported for the quarter. On performance, overall average quarterly availability is 99.52%, which is largely due to all the scheduled outages which we plan typically in Q4. But on annualized basis, we almost hit our target of 99.75% with 100% maximizing incentives. On solar generation, we achieved 23.9% CUF with a generation of 445.8 million units. On reliability, we achieved 0.13 trips per line, which is one of the best in our sector. And in Q4, we achieved 0 trips for entire substation. So we are continuing our efforts to maintain consistent performance based on our reliability-centered approach and coupled by digital technology with best-in-class operational excellence. With that, I would hand over to Naveen on slide 9.
Thank you, Satish, and good evening, everyone. We are on slide number 9. Another good quarter with robust performance. We have recorded a revenue and EBITDA of rupees 786 and 655 crores respectively, which translates into 31 and 24% YY growth. NDCF generated for the quarter was rupees 451 crore, and board has approved distribution of rupees 3.55 per unit. That translates into DPU growth of 3% on YY basis. With this, FY24 DPU stands at rupees 14.1 per unit, a growth of around 6% compared with FY23. Coming on to collections for the quarter, it stood at 119 and 89% respectively for transmission and solar business. For FY24, collection performance at entity level stood at 103%, with both business segments having collection performance greater than 100%. The DSO as of 31st March 24 stood at 46 and 71 days respectively for transmission and solar business. This reflects improvement in DSO in both the business segment by 8 to 10 days on YOY basis. Moving on to next slide, number 10. DPU for the quarter is rupees 3.55 per unit. It will be distributed in the form of interest and dividend, which is rupees 2.74 and 0.81 respectively. The outstanding units at the end of the quarter is 78.37 crores, and the distribution to all the unit holders comes to rupees 278 crores. Record date for the distribution is May 30th, and tentative date by which the unit holder will receive the distribution is June 8th. NAV as of March 31st stood at rupees 133.15 per unit. Post this quarter's distribution, IndiGrid would have distributed rupees 85.97 per unit with a total distribution of around rupees 4,945 crores. On the right-hand side, we showcase the trend of distribution on year-on-year basis, which is stable and scalable growth of 6% over the years. Further, continuing past trend of distribution for FY25, quarterly DPU guidance has been increased to rupees 3.75 from rupees 3.55 per unit, which is a growth of around 6%. Coming on to next slide, number 11. This showcase the waterfall from our EBITDA to the NDCF generation and distribution. At an SPV level, we have a consolidated EBITDA of rupees 670 crores, net of finance income, working capital movement, and capex at SPV level. NDCF generated at SPV comes to around rupees 813 crores. The net of the trust level expenses, finance costs and tax, we have generated NDCF of rupees 451 crores. In Q4 and FY24, we have added rupees 128 and 143 crore respectively to our reserves, and closing reserve stands at rupees 465 crore, which is in excess of one quarter's DPU basis current guidance. So that's all from my side. I hand over to Meghna to take the subsequent slides. Over to you, Meghna.
Thanks, Naveen. Hi, everyone. I'm on slide number 12. Looking at the balance sheet for IndiGrid as on 31st of March. We continue to be AAA rated by all the 3 rating agencies, and we closed the fiscal year with an average cost of debt of about 7.68% and a very healthy cash balance of about 15.94 billion, of which one quarter's distribution, Q4's distribution is already included, plus about 440 odd crores of DSRA. Also includes the cash balance part of that. More than 75% of our borrowing book of 192 billion is in the form of fixed rate borrowing, to that extent insulating the borrowing book against short-term variations in the interest cost. Our net debt to AUM, the leverage ratio remains at a healthy 62.4% on the back of the equity raise that we did around 1,070 crores in the last fiscal. EBITDA to interest coverage ratio remains very healthy at around 1.86. The gross borrowing book is almost 50-50 divided between NCDs and bank loans. Even as far as NCDs are concerned, they are subscribed by a lot of different classes of investors, including mutual funds, banks, financial institutions, FDI investors like IFC, PSU banks, so on and so forth. The graph that you see at the bottom of the chart reflects the refinancing schedule, and as you can see, it is smoothly divided over the next few years, ensuring that we do not bunch up any debt maturities in any particular year, trying to maintain that level at not more than 14-15% of the gross borrowing book. Moving on to slide number 13, talks about the total returns that we have been providing to all the investors. The total returns comprise of distribution till date, which is about 79%, and the price appreciation of 33%, translating into absolute total return of 111%, and that annualized translates into 12%. We compare ourselves on the left hand side with pure play debt instruments like GSEC bond, 10-year and 30-year, and on the right hand side with pure play equity indices, right, like NSE 500, NSE Infra, BSE Utilities. More importantly, with the run up in the equities, you can see that the annualized return on equities have certainly gone up, but on a risk adjusted basis, which is reflected through beta, IndiGrid's beta being 0.08. On a risk adjusted basis, IndiGrid still consistently has been outperforming both the debt and the equity indices. Moving ahead on slide number 14 on the business outlook for FY25. On the portfolio strategy basis, we continue to focus on ensuring operations remain stable by ensuring predictable and sustainable distribution on the back of value accretive acquisitions, both on the transmission and renewable assets. On the back of the 5 greenfield projects that we have recently won, complete focus remains on execution of this work on both the transmission as well as the BESS projects. Synergistically also looking at participating few more opportunities that will come our way in the current fiscal, as well as deliver on the DPU guidance of 15 rupees for FY25. Balance sheet strength and focus on ensuring that that continues remains again as one of the top priorities, by ensuring that we optimize the interest cost and try to see that we elongate the tenors as and when there are refinancing opportunities or acquisition opportunities that come through. Similarly, we try and maintain the leverage ratio as much as possible by ensuring that there is enough headroom that is available for future growth. On the asset management side, both on the digital asset management, the health index that we have introduced reflects on our priority and on ensuring maintaining at least 99.5% availability across the portfolio, as well as ensure world-class EHS and ESG practices throughout. Industry stewardship again continues to be a focal point for us as InvITs, wherein we try to participate in ensuring investor education happening regularly, and at the same time ensuring private sector participation gets priority in the electricity sector, both in greenfield projects as well as national monetization pipeline. Moving on to slide number 15, this reflects on how our DPU trajectory has moved on the back of accretive acquisitions that we have done since the time we got listed. The various color bands that you see talk about the acquisitions that we have done over the years, and on the back of these acquisitions, how we have been able to grow and maintain the increased DPU for the sustainable period over the future. So that is what is reflected by this slide. I'll just take a pause here and open the room for question and answer, please. Shubhadeep, over to you.
Yeah, perfect. Mike, can we please open the floor for question and answer? Thanks.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question on the line of Pratik Kothari from Unique PMS. Please go ahead.
Yes. Hi, everyone. Good afternoon. Thank you, and congratulations for the consistent performance for the past 5-7 years. So my first question is on this, the new entry which we have made over the last 6 months, BESS, the battery energy storage. Harsh, if you can speak more about that and explain what kind of business that is. I mean, what kind of CapEx does it incur? And not just from our side, also from the customer side. I mean, given a DISCOM is putting up this battery energy storage, and what does it cost for them to store this power? Recently, there were talks about central government having to come up with some viability gap funding because it didn't seem economical. How much is it for the project that we have won? Just broadly, if you can help us explain or understand this business or economics of this.
Was the management able to hear the question?
Yes. So thanks, Pratik. I think for us, battery energy storage projects are almost exactly similar to transmission projects. Even the bidding framework is pretty much similar in terms of TBCB form, except that instead of transmission service agreement, it is called battery energy storage service agreements. So it's identical from the concession agreements that we have followed in the past. The payments, or rather the business model or the operating model, is also based on availability. So as long as the batteries that we manage provide a certain availability as well as a output efficiency, we continue to get paid whether the customer uses the charging and discharging cycle they have provided or not. Irrespectively, you get paid. So practically, it is almost like a substation project that we have managed. So that's point one. Point two, in terms of the customer CapEx, customers in this case, or rather in most cases, would not be incurring any CapEx. It would be in their substations, and therefore, rather they are outsourcing CapEx. So we are doing CapEx on their behalf, and they will pay us an annuity for 10, 12 years as the bid might be. So the business model is that instead of incurring expenditure on their books, they are calling bids, and they will pay an annuity bid for that. Just to provide you a little bit of context of economics, the tariff at which we have won a few projects would be in the range of around 4.5 rupees a unit. And the primary driver for this tariff being reduced substantially over the last 1 year has been that the cost of batteries have come down drastically over the last 1 year. And I think at the 4.5 rupees, we are looking at an inflection point, because for serving peak demand, if one was to use solar plus battery in the evening, the cost would come around 6-7 rupees, which is pretty much, I would say, at a grid parity to serve peak load in the evenings or morning. So I do think there is a real business case where we will see a lot of growth on the battery energy segment from different customers, as long as the prices remain down. So we are hoping that a lot of growth in this area will take place. But the business model, to your question, remains as our normal bid, own, operate, and transfer kind of business model.
Correct. And if you can share what is the CapEx that we'll have to put up for this 180 megawatt, the one we are doing in Gujarat? And when we say 180 megawatt, 360 megawatt, that means we have to keep this battery available for 2 hours. That is the contract which we have to serve.
It's a little more complex than that, but yes, we need to do 2 hours of availability, but there are also cycles. So this project has 2 cycles. Some project can be 1 cycle. So it is not easily comparable. Each project is not easily comparable over here, because based on the cycles and location and customer requirement, there can be sizable amount of difference between project to project. Having said so, this project that we have won has got 2 cycles, and 180 megawatt means the peak capacity. 360 megawatt hour means 2 hours of battery storage. And the cost of the capex, we still in place of, I would say we are in place to order, in process of placing the orders, but it is in the range of, somewhere around 550 to 600 crores.
Correct. And this 4.5 rupees, which is mentioned would be the cost for the discom, this does not include any gap funding that central government has to do, right? This is
no. This project is not under any viability gap funding, and this project economics is not dependent on any VGF being received from the government.
Right, fair enough. And as on the risk part, the battery technology, keeps evolving every other year. So what happens in case things change a few years down the line? That is one. Second, given this is very new technology, what happens if this doesn't perform as expected? Because transmission line has been in existence past many decades. This is quite new. And third, what happens after this 10, 12 years?
So I think point one, the technology is evolving massively and it is evolving for better. So efficiencies are improving. So as the new technologies come in, we will see probably reduction of costs, and we are hopeful that it happens, and it will help us in further augmentation if we have to do. To your second question, I think we need to do a little bit of more work around it as a country, to raise awareness. So most likely today, the largest amount of battery capacity in the world exists in China, and it is not in one few 10 gigawatts. It's over hundreds of gigawatt of manufacturing capacity of lithium-ion batteries exist. This technology itself is not new. Technology exists for decades in satellites, in our phones. It is the same technology at a different scale, different application. So the lithium-ion technology, I won't call it new. It is extremely stable, extremely viable, and used technology across the world. So I think it's just one, and we have a lot of exposure, and we have looked at a lot of technology as well as manufacturing plant, operating plants in China. The capacity is tremendous. The use case is tremendous, and they are treating it as a base technology, not as an emerging technology. I would say sodium ion is emerging technology, but lithium ion is a base technology which has been existing for decades. So we are not worried about the risk of the technology itself, but we do see the technology improving year on year, and that would add edge to us rather than
Correct. And what happens once, the battery would have a life of about 8, 10, 12 years, depending on how much we use it. What happens post that?
So, variety of business cases are possible. Battery will have a very long life. Even after 10, 12 years, battery will have I would say, SOH, DOH will be slightly different because the depth of discharge and stuff will be slightly different and may not be wise to use as a utility scale battery storage, but battery is still a battery. Can be used, can be recycled. There are multiple business cases. And depending on the cost, technology, and what exists 10, 12 years down the line, we can find an application. Rather, I'll tell you today, there is a very vibrant battery recycling industry in India itself, forget about China. So, but to predict that what will be the price of batteries and recycling 10 years, 20 years down the line would be a little bit too much crystal ball gazing. But I can tell you there is sufficient applications that exist after 10, 12 years.
Correct. But none of this is captured when we bid for the project. In our
I don't think I can answer that question, Prateek.
Okay, fair enough. The second, so one is to maintain this DPU. First of all, a great increase from where we started. So one is to maintain this DPU of 15 rupees for as long as possible, and second is this accretion which we intend to keep doing over a period of time, and we have done a fine job over the last 5-7 years. But as we keep growing larger and larger, does it become harder to kind of capture this increase given the number of projects or the size of projects that we have to keep onboarding?
To your question, yes, as you become larger, it takes more effort to grow on a larger base, 100%. I mean, 5 years ago, 2,000 crore would have added sizable growth. Now 2,000 crore becomes the 8% growth on the overall book size. So as we become large, we obviously have to target larger projects and larger growth pipelines. Fortunately, the market that we operate in has been growing very fast and large. So we are hopeful that we'll be able to, keep up our share of growth rate that we are working towards. And then the first question, I think we do publish indicative EPU profile, but it's indicative, but it's published on slide 15. You may want to refer that. There is a sizable amount of, I would say, path ahead of us where we can maintain 15 rupees a unit without acquiring any more projects, which allows us sufficient time to maneuver, find projects, develop projects, acquire projects to ensure that we are able to maintain as well as grow DPU.
Correct. And last question from my side. I mean, we commissioned Kalam, our first greenfield. So if you can just share some experience, how is it putting up? How is the team being developed? Because now we are also taking up a few more greenfield projects.
Yeah. So what we have done is we have made a separate business unit within IndiGrid towards projects. It's headed by a extremely senior gentleman who has got very deep experience on power sector. And so we have put together a business unit on project side as we go for larger projects, because we just don't have Kalam one. We also had several regulated tariff mechanism projects going on across the country already on our substations. So there is a lot of capex happening in our portfolio, put together 2,000 crores of TBCB plus around 400 crores of costless projects, in all 2,500 crores of capex that we are doing. So we have identified several of our team members within IndiGrid itself who have done capex in the past, who have been reassigned the responsibilities on the project side, and we are augmenting further as we look for other projects. So I think the core talent remained in IndiGrid from the beginning, and wherever there was, I would say, leadership required, we've added leadership capabilities on the execution.
Thank you and all the best.
Thank you.
Thank you. Participants who wish to ask a question may press star and one on your touchtone telephone. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the next question on the line of Shubhati Mitra. Please go ahead.
Thank you. Hi, Harsh. My first question is again with regard to the BESS piece. If you could just highlight for us, what has really changed over the last 6 to 8 months, which has led to this sharp reduction in costs. What we understand is, okay, while lithium prices have come off, may not have come off by more than maybe 20-25%. So is it that there is a function of probably some near-term or medium-term dumping by China because they are not able to sell enough batteries to the European EV industry given restrictions there? Is this more of a short-term event or a near-term event? Or do you see that there is a structural change in battery prices and they will keep on getting cheaper? That's my first question.
Thanks. I think to answer the first question, I would say I won't use it like use the word dumping. There is a significant scale that China has created in manufacturing batteries. And it is a scale business because the larger the plants are, the lesser the cost is. Second, there is significant advancement of technology that Chinese have invested in. So a few years ago, there used to be cell size of 200 ampere hours, then 250, then 280, 314. And now this year, most Chinese have announced 350 ampere hour cells. And just to put things in context, between 350 ampere hour cell and a 280 ampere hour cell, in the same volume, you can pack 25% more power, right? So essentially, you have reduced the rest of the balance of supply cost by 25%. So there is a lot of advancement on R&D side that they are working on, as well as they have got the scale. Now, the biggest driver, other than the lithium prices, what we feel is overall globally, the EV expansion or rather the growth that was estimated has not taken place. And most manufacturing facilities at the cell level are pretty similar, but rather same for EVs as well as utility scale storage. So the EV growth that the world was factoring in has not taken place for a variety of reasons, political, economical, whatever reason.
Right.
This has resulted into a lot of capacity being available for utility scale battery storage, where the application is kind of very, very viable. So a lot of capacity, technological advancement, and I would say a glut in the market. All three things are contributing together. On top of it, yes, as you mentioned, especially US is also not importing batteries from China, if I'm not wrong, or cells, so that has reduced competition, or that has reduced prices in China. So I think many factors put together are contributing. I would not call it a short-term phenomenon, but at least mid-term, I do see this continuing, a lower battery price. So hopefully it remains like that.
Understood. And just like we've seen, India also trying to, we've seen that in solar modules, right? With the LMM, everything, we are trying to become more self-reliant and let's say not have as much dependence on China. So, do you see things panning out in a similar manner in batteries also, or that's still some time away?
I think it can, because it's not impossible for India to develop that capability. What is difficult is to match the scale, right? For example, as battery storage, we are not comparable. We are not even putting half a gigawatt of battery storage. But solar, India's total installed capacity is 90 gigawatt hour, right? Approximately. China put in 280 gigawatt hour in last 1 year alone. In 1 year. So the scale is different. Now, will we be able to create the scale is the question. Yes, the government policy on PLI and another policy of putting trade barriers would help Indian manufacturers for a couple of years to build capacity. There are a lot of dedicated battery manufacturers in the country, right? And they are large themselves. So I do see that there is a possibility that we can expand into it. But to stabilize a new plant, to produce out of the new plant, and customers accepting those batteries out of the new plant and implementing, in my mind, is at least a 3-4 year cycle. Okay? So if the government starts today, or let's say 6 months down the line, I see domestic utility scale batteries, and when I say domestic is a cell manufacturing, at least 3-4 years away. But that's a midterm, and I do certainly see that happening and taking place.
Understood. Lastly, on the diversification that we've seen for IndiGrid, right? You've moved beyond just buying transmission projects or mature transmission projects from others. You're constructing, getting into greenfield. There is solar, there is BESS. So, in terms of your risk balancing that you tend to do, how much of your AUM do you see moving towards these newer areas, and do you see any incremental risk which can come to the instrument?
Yeah. No, I think, one of our core values is agility. We are agile. We do keep evaluating opportunities. On the other hand, we are conservative. So I won't call it any of them as a newer area. I think we have pondered upon, experimented a lot on every business expansion that we have done. For example, before getting into batteries in this way, we have installed the first battery proto plant in our substation, matched with solar to make our substation grid independent. So we consume during the day solar and in the evening battery. We made it work in our own substation 2 years ago. So we have our own design and engineering and work done on those plants to learn, get our hands dirty before we expanded to this area. So that's on battery. Same way on solar, we acquired a 100 megawatt plant, operated it for a couple of years before we took it to a gigawatt. On the development, we did a 200 crore capex, we completed it, and now we have a 2,000 crore pipeline. So we've gone strategically, first taking a step, proving the concept, capability, building the capability, learning the ropes, and then expanding. So by the time we have really done something meaningful and sizable, it's no more a new area, right? So that's how we have gone about it. In terms of risk reward, it's largely homogeneous. Most of them are annuity linked, so we don't see that as a material risk. And even in the projects that we have gone on the under construction side are fairly de-risked. So we would like to move in that direction, and we are confident that we're not adding a substantial amount of risk because of that.
Okay. And is there an in-house target or a threshold that you have as to how much would get allocated towards these newer areas, or it's fairly homogeneous?
See, the battery storage is kind of a core area as part of transmission. On the development side, we will not cross 10% of capital deployed. That's what is the part of our overall SEBI cap. But renewable will remain around total 25%. So that's the overall guardrail within which we'll operate.
Understood. Thank you so much. I'll get back in the queue.
Thank you.
Thank you. We have the next question from the line of S. Agarwal from Max Life Insurance. Please go ahead.
Yeah. Hi, good afternoon. Collection efficiency for solar asset has reduced to 89% this quarter, versus 128% last year, same quarter. So is this as per your expectation, better or lower? And is there any specific counterparty where you are seeing the collection efficiency to be lower?
Thanks. I think if you look at the quarter-on-quarter comparison, right, it looks like 128 to 89, but on a full year basis, it's still 101, right? So it's still collecting past dues. So our quarter 2 and quarter 3 are very good. And typically what happens in general is when your couple of quarters are very good, the third quarter is down because the customer is paid out of, substantial amount of dues. So then they take a breather and subsequently increase. So we don't see it as systemic. We don't see as one particular customer delaying. It is just a normal trend that we have seen that once you have a large quarter, the next quarter or quarter after that is relatively.
Okay.
Do you have any further questions, Mr. Agarwal?
No, thanks.
Thank you.
Thank you.
We have the next question on the line of Vipul Kumar Shah from Sumangal Investment. Please go ahead.
Hi, thanks for the opportunity. So my question is regarding our new acquisition of this solar acquisition. So what type of quarterly revenue and EBITDA run rate we can expect from this asset on a steady state basis, sir?
Yeah. Meghna, you want to answer that question? On renew, I believe you meant on renew acquisition, right?
Yes, sir. Yes, sir.
Yes. Thank you. Yeah. Meghna?
Hello?
Yeah, one minute.
Yeah.
So on annual basis, the revenue from the renew asset would be in the range of around 700 to 710 odd crores. And on the EBITDA basis, revenue would be about 200 odd crores in that range, 190 to 200 odd crores. And EBITDA will be somewhere about 175 odd crores.
Okay, thank you.
Yeah.
Thank you. We have the next question on the line of Anirudh Singhi from Dalal & Broacha. Please go ahead.
Hi, good afternoon. Just correct me if my understanding is wrong. Our NDCF for the year was around 1240 crores, right? And we have to pay out 90% of that, which is around 1120 crores. But we paid only 1050. So how do we account for the missing 70?
Yeah. So to clarify, the NDCF formula has two legs, and it is changed with the new SEBI regulations. NDCF formula required us to distribute minimum 90% from SPV to IndiGrid, and from IndiGrid to investor, another 90%. So it is a 90% threshold at SPV level and 90% threshold at IndiGrid level. So therefore, effectively, it is 81% mandatory. And therefore, that's the math that I need to run, that 90% at both levels. Having said so, SEBI has implemented a new NDCF formula applicable from 1st April 2024 onwards, whereas they have put in an obligation of minimum 90% at a consolidated level, the way you calculate it. So the formula has slightly changed
coming from next
for
year.
this quarter onwards. Yeah, from this year onwards. But otherwise, it was 90% of 90%.
Right. Okay, thanks. And just that now that we have a sizable solar portfolio, are we also looking at wind and hybrid projects, or do we not have the capabilities for that? Or?
At this point in time, we are not looking at it. We do have capabilities for that. Satish, our Chief Operating Officer, has done a lot of wind projects. He was earlier GE Wind COO. So he's done a lot of wind projects in his life. But at this point in time, we are not looking at hybrid projects or wind projects.
So is the economics that it doesn't add up, or why is it that we're not looking at wind?
I think wind projects, first of all, wind projects manage it efficiently require scale. And if you have a large amount of wind projects, that may add variability to our business, which we don't like. So I think that's one. And second is our right to win is not very clear on hybrid and wind projects. In whichever area we have entered, whether it's solar, whether it's battery storage, whether it's development of transmission, at least internally we have been able to clearly identify and convince ourselves of our right to win in the marketplace. On wind and hybrid side, I would say even though a lot of us have worked it independently, we're not sure a right to win exists so clearly at this point in time, and a risk appetite. So that's what has kept us away.
Okay. And lastly, do you have any update on the monetization, the power grid monetization?
No updates really from our side. In fact, we haven't heard anything.
Okay. All right. Thank you.
Thank you. We have the next question on the line of Shyam Karwa from Karwa Investment. Please go ahead.
Yeah, congratulations to the team for excellent operational and financial performance, as well as the growth in guidance given for the coming financial year. I have one or two small queries. First one is regarding delay in the quarterly results. We are generally seeing the IndiGrid is declaring results in the first or second quarter of May. But this time it is, I think, delayed by, say, some 15 days. Any specific reason for this, sir?
No specific reason. We plan our quarterly and annual board meetings in advance. So our directors' availability as well as, the annual audit takes time. So I think between both these factors, we are well within a statutory timeline. So that's how we follow about it.
No, it is definitely within the statutory timeline, sir. But as far as IndiGrid is concerned, we expect something more, and we are habituated to that. So it will be better if in future the time limit taken for declaration of quarterly results is as per the previous practices. It is just our suggestion.
Thank you. Thank you for your suggestion.
Okay. Next, we are always talking about stable and sustainable DPU, sir. I just want to know the risk factors, the major risk factors, if any, which may dilute this commitment.
Yeah. No, I think it's a very, very deep question, Mr. Karwa. I think, there are a variety of risk factors. The first one, I would say, which can have a major impact, right, is cost of financing, right? Which is we run our net debt today is around 17,000 crores. So cost of financing can have a sizable impact. While we do everything in our power to, hedge and lock in and do different type of instruments, eventually it's market. While we have seen ups and downs of the cycle over the last 6-7 years, we have done everything possible to keep our costs within, of 7.5 to 7.7, pretty much in that zip code for a long period, even though during extreme market volatility or interest rate side. Having said so, it's not, I think it is still the biggest risk factor, right? It can change. It can change, like you all saw, while we believe that the RBI guideline that has come up, or the draft, it is not applicable on us, it's applicable on project financing. But, the regulatory actions can go in any direction, right?
Yeah.
And that can have a major impact. So I think factors like that impact our cost of financing can be one big operating risk. The second risk is we are in 22 states, right? If you look at the presentation, our total number of assets are 49 lines, 15 substations, so about 64, plus about 16 solar projects, so 18. Adding new locations that we do to around 85 to 90 locations in the country across 22 states and UT. So there is always something happening, right? We are social assets. Anyway, there can be floods, there can be heat waves, there can be flash floods, there can be riots. There's something or the other happening. And when we have a large portfolio, there is always something that can happen to our assets, right? Because we are cross-country. So that's the second biggest risk, right? To impact on our assets because of natural calamities, man-made calamities, different things. Now, we are very diversified. So no one asset has ability to move our business materially. But even after that, it is the second biggest risk that I see to the business. Third risk I do see into our business collections, as I think many of the investors did ask. If a collection gets stretched from customers, that also can have an impact. Like we have cushions in our cash flows, we have sizable cash balance and all that, but I would put that as a third risk. So I would say between these, you would have covered, high level significant risk of the business.
Yeah. As far as this finance cost is concerned, I think the interest rates are at their peak. So in future, if the interest rates go down, whether we are going to get benefit out of that?
I mean, your question was on risk, so I described the risk. When you oppose the risk, it becomes opportunity.
Yes. No, there is a silver lining in every cloud, no, sir.
Correct. Yeah. So it can become an opportunity for sure. I don't want to predict it, but it can become an opportunity. Yeah.
As and when it happens. Regarding the solar assets, I have a small query, whether there is any seasonality aspect in this solar generation. This quarter, okay, it was good. In future quarters, whether it will be plus or minus or something like that. Any such seasonality factor is there, sir?
There is seasonality in solar aspect. It is not as much as wind. Satish, you want to give that answer, please?
Yeah, sure, Raj. Yes, sir, there is certainly seasonality, the way seasons are changing.
Yeah.
And also, of late, we are noticing bit of shift in climate patterns as well. But good part of wider portfolio is we are diversified across various geographies. So if one state has problem, another state can, compensate for that. So that's the benefit we get with a diversified geography. Yeah.
Okay. Just one last point, Mr. Harsh. Regarding natural calamities, I think we must be having some insurance coverage for that.
Yes, we do.
Because I was seeing in the profit and loss account, the insurance expenses are substantial, some 24 crores in this financial year it was there. So this insurance cover, whether it is only for the assets or for the operations part also?
No, so I think insurance is the biggest cost in a P&L. And yes, we do take a very comprehensive insurance. So it is covered for all natural calamities, Many a times revenue loss also is covered. It depends on what events will cause. But yes, a sizable amount of insurance protection is there.
So it means we are taking covers and precautions for all possible risks. That is my impression.
Yes, that's what we are trying. Yes.
Okay, because why I am asking so many questions is I am having good confidence on IndiGrid. So I am suggesting my friends and relatives also to invest in IndiGrid units. That's why I have asked so many questions.
Certainly. Thank you.
Okay. So we hope you will do better and better in future, and we will get the fruits out of that.
Thank you.
Thank you. Thank you.
Thank you. We have the next question on the line of Sunil, an individual investor. Please go ahead.
Hi. Congratulations on a excellent quarter and consistent performance over the last 6-7 years. Given that you have increased your solar asset the mix quite substantially over the years, I just wanted to know whether all those solar assets, the plants, are in the land that they are on in the owned category or leased category or rental. Because given that land acquisitions and everything that goes on in India, I think it would be, no matter how remote they are, would be of value going forward. And are there any scope for brownfield expansions or in that area that you already have in your solar assets, whether it's for DSS or for adding some more of solar assets? Thank you. That's all my questions.
Thanks. I don't think there is sizable expansion opportunity in the current assets. There is not much free land. It is very limited. On the land side, I think we'll have to check, but give or take around 50% or 20% of capacity will be in the owned land. Rest all is going to be either a solar park or leased or rental land. So we don't see beyond that 20% of the capacity being in the owned land. However, we have seen that even in the rental and lease land, especially in the tariffs which are competitive, right, like 2.5 to 3 rupees tariff, we do see there is a sizable extension possibility. Because let's say 18 years down the line, most of the lease agreements are also extendable, and we do see, depending on the power tariffs at that time, if 3.5 rupees is competitive, we might be able to extend the lease and extend the contracts or even sell it on the exchange. So that opportunities do exist in most of those contracts.
Okay. Thank you very much.
Thank you.
Thank you. We have the next question on the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir. Sir, now that...
sorry to interrupt, Mr. Gupta. There is a lot of disturbance from your line. If you could go kindly off the earphones and come on the handset mode.
Yeah, is it better now?
This still is not very clear.
Okay, so my first question was that now that we operationalized our first greenfield project after 2.5 years, and so what are some of the learnings, both positive and negatives, that we were able to understand about our own capability in the project side?
There's nothing new. I think most of the core team that has come here, including me, have executed 25,000 crore projects in our roles in Sterlite before. So we already have learning from there that we carry forward. So I don't think there are incremental learnings for us. Obviously, in the IndiGrid setup, we are doing it for the first time. And for us, it was just starting small, proving that this works for you guys, right, before really making a larger bet. So I would say individually, professionally, no material learnings per se, because we've already lived through the cycle.
Okay. But generally, in case you are putting any projects anywhere, there's a lot of management which needs to be done at the local level to be able to deliver on time and make sure that what the intention is actually being executed on the ground. So how are we able to successfully sort of do it?
So I think point one, we need to have people on ground, and that's something which we're aware, and we put people on ground upfront. So that's one. Second, the project that we chose was substationary project. So once we acquire land, we work within the perimeter, so it makes it relatively easier. And there was only 14 kilometers line. It was not a big, long stretch. However, we worked in Maharashtra, so it was a difficult state in terms of generally dealing with several social aspects. But I think the main point is that if we can plan it early, we keep our contingencies and people accordingly, then it is a matter of, like any other project, of managing man, machine, and money. Right? It's simple as that, and the same thing applies to our project. So I think we are able to do it, and I think we can repeat it.
Understood. And you mentioned that you have got the right to win as per your understanding in some of the other businesses apart from projects like battery as well as solar. So, I mean, apart from the cost of funding, have we established other rights of win also? I mean, what are the things that we have learned about ourselves which are helping us probably do better than what our initial estimates were in these two areas?
I won't say cost of financing as the only win, because that can apply to hybrid and solar also, right? I think the point is about discipline, about knowing what we know and knowing what we don't know. And that's why we don't know how the hybrid projects will work for India, so we did not want to take a bet. On battery storage side, there is enough work that our teams have done over the last 3 years. So while the news has come now, right, in this quarter, but it is a hard work for our teams of 3 years of hard work of research, engaging with partners, visiting China, seeing plants, doing experimentation of projects. A lot of these things are the ones that gives us insight and experience, right? And then we finally go and build. So it's much beyond cost of financing. It's these kind of things also add to that. Certainly there are advantages of tax and financing that helps us in any business. But eventually, knowing the business, its risks and opportunities, and where one can save money and reduce risk is the key. And I think if we have done it somewhere, it's easier to repeat. For transmission, as I said, all of us had the experience of doing it, so for us it was repeat. For solar also, most of us professionally had worked for solar business elsewhere. And when we did over here, we just got the basics right for that. So I think the focus is on discipline, knowing the business, knowing its risk and opportunity, and then bidding. That's how we go about it.
Understood. And lastly, when we look at our portfolio, do you also see some opportunities for exits, primarily because now that you have been running these assets for a long time, you would have made some differentiation that some of these assets may not be as good as others or may create some problems later down the line. So is that thinking existing, or all the assets are more or less commoditized or similar, and hence we feel that everything should be run till the tenure of these assets?
Okay, I'll tell you, we have not thought about it. In any case, SEBI regulations do not allow sale of assets with less than 3 years of holding period. Second, our own strategy is buy and hold. We are not a buy and flip kind of trader, right? We are a utility. We buy projects and keep projects, earn yield and deliver to unit holders. So we haven't given thought strategically or tactically to really monetize assets. That's not part of our business and operating model. We haven't really operated that much. And if somebody comes and approaches that will give you some obscene value for some asset, then we'll take a look at it at that time and we'll do what is right for the unit holders. But at least from our side, our strategy is not to really monetize assets. Our strategy is to juice assets and give yield to our investors.
Understood. Thank you, and all the best.
Thank you.
Thank you. I would now like to hand over to Mr. Harsh Shah for closing comments.
Thank you. Thank you for all our investors for joining the call today and asking very, very intelligent and deep questions. We are working for you, and we are pretty happy as the level of questions have improved, and you are taking deep interest in the business and asking the right set of questions. We are always there to address them. We will continue our path of delivering stable DPU and growing it, especially now that we are working on the organic growth. We do look at the 10% capital we can continue to deploy and do organic projects which provide the yield kicker to our unit holders. Thank you.
Thank you. On behalf of Nuvama Wealth Management, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.